Imagine two customers walking into the exact same bank. One deposits a portion of their paycheck every month, keeping a large cash balance. The other relies on credit, carrying a balance. It is the borrower, the one constantly in debt, who generates significantly more revenue for the institution. We are taught to view financial institutions as heavily guarded vaults, whose primary purpose is to protect our savings. But banks operate like any other commercial enterprise. They are in the business of selling, and their primary retail product is money itself. To understand how they sell money, we have to look at a concept called the net interest margin. This is the business model driving almost every lending institution. Customer deposits flow into a central pool, cheap raw materials paying savers almost nothing. The bank packages this into auto loans, mortgages, and personal loans, sold at steep markups. The difference between cheap incoming deposits and high-priced outgoing loans is the net interest margin profit. From the institution's perspective, every dollar sitting in your checking account is simply inventory waiting to be sold to a borrower. Sitting at the very top of the bank's product shelf are credit cards. Because they carry some of the highest consumer borrowing costs on the market, they are a uniquely lucrative asset. This bar chart shows a $2,000 credit card balance paying only the minimum. Over years, compound interest relentlessly multiplies the debt. With missed payments, penalty fees are added. Eventually, interest completely eclipses the original $2,000 borrowed. By extending the repayment timeline, a handful of minor everyday purchases are transformed into a massive multi-year profit stream for the lender. Knowing how profitable these loans are explains why inboxes are constantly flooded with pre-approved offers, instant loan alerts, and unsolicited credit limit increases. Lenders track repayment data to identify reliable, low-risk consumers. Offering these specific individuals a higher credit limit is a highly calculated way to increase product sales without taking on excessive risk. While the bank relies on cold, rational mathematics mapped out over decades, the consumer is often operating on an emotional, short-term mindset. The urge for instant gratification, the fear of missing out, and unchecked lifestyle inflation drive people to purchase things they haven't yet earned the capital to afford. This behavior is reinforced by the minimum payment illusion. Meeting the lowest required monthly payment feels like responsible financial management, but mathematically, it traps the buyer in a cycle of expensive debt. The system thrives precisely because human desires are immediate, while the crushing math of compound interest is slow and largely invisible. Debt is not inherently malicious or virtuous. It is simply a financial tool, and its value depends entirely on how it impacts your personal wealth. Good debt acts as leverage. It is money borrowed to acquire appreciating assets or to increase your earning potential. Taking out a mortgage to buy property or securing a business loan to launch a company falls into this category. Bad debt, conversely, is high-interest borrowing used to finance depreciating assets or fleeting lifestyle purchases that offer no financial return. The wealthy utilize good debt to deliberately build their net worth, while others allow bad debt to quietly drain their future income. The most effective defense against this system is to pay credit card balances in full every single month. This allows you to utilize the convenience and security of the bank's payment network without actually purchasing their interest product. Building a cash emergency fund is equally critical. It acts as a buffer, eliminating the risk of being forced into high-interest borrowing during a sudden medical crisis or job loss. When borrowing is necessary, treat the loan exactly like any other retail purchase. Actively compare interest rates and shop around at multiple institutions before committing. Banks generate revenue whenever money moves, but consumers build lasting wealth only by controlling how and where their own money moves. Understanding the specific mathematical mechanics of the banking business model is the best way to ensure the financial system is working for you, rather than you working for the financial system.